welcome to the latest episode of this unbelievable life. I have with me today my dear friend Stacy Sorenson with Ruoff Mortgage. And Stacy and I are going to be doing not just one podcast, but we're going to be bringing you a little bit of a series. She and I sat down, we had lunch together, and we just feel it's very important, not only just for first-time home buyers, but anybody that wants to jump into the home buying market to have a good grasp on their credit. And young or old alike, this is a big deal, and knowing what's going on with your credit. So I'm going to let Stacy take it away, and we're going to hit this first one pretty hard and talk about late payments and a lot of juicy topics on credit. So Stacy, take it away.
Hey, well, thank you so much, Nikki. So again, I'm Stacy Sorenson with Ruoff Mortgage. So let's just start with the absolute basics. So what is credit? Okay, so your credit is defined as money, goods, or services given with the expectation of future repayment. So typically when we're talking about that, it's the most simple to look at a loan. So you go into your financial institution, you ask them to borrow money to say to buy a car, you sign an agreement saying, hey, you're going to lend me this money and I'm going to pay you back so much each month until that loan is repaid. So let's talk a little bit then about what your credit score is. So this is a tool that's determined to really see what your risk is and how you're doing your repayment. So this can range anywhere from the lowest at 350, the highest score you can have is an 850. And what these numbers do is they indicate your financial stability and your trustworthiness. So your credit score is also referred to a FICO score. So that comes from the Fair Isaac Corporation. And this is the model that we use to determine your score. We look at the three main credit reporting bureaus, which are TransUnion, Experian, and Equifax. So each of them do analyze your credit a little bit different. So you will see some variation in your score from all three of them. However, they're going to be pretty close. All right, so let's just kind of talk a little bit about the different types of credit, different types of debt. So the first one we're going to talk about is an unsecured loan. So an example of that would be, let's say you take out a loan to buy furniture for your house. So whoever the store is, whatever it is, they will loan you the money to do this, and you're expected to pay that back. What's a little unique about this type of loan, since it's unsecured, if you don't pay that back, they're not going to come back and take your furniture, right? So because there's no collateral with this type of loan, you're typically going to see a little bit higher of an interest rate. So let's go to a secured loan. Okay, so that's going to be the opposite. So with a secured loan, an example of these would be an auto loan, your mortgage. So with that, the collateral would be your car, would be your house. And with these, you're going to have a set loan amount, a set interest rate, and a set monthly payment that you're going to agree to pay over a certain amount of time. The next type we're going to talk is about revolving debt. And the most common revolving debt is going to be your credit cards. So with those, it's a flexible option. You're going to have a credit limit. So you have so much that you can potentially use or borrow, and then you pay that back each month. And this continues to go. So you have a constant influx of available money as you pay it down. All right, so let's talk a little bit about really what makes up that credit score, right? So we kind of talked about what credit is, the different types of loans that build your credit, okay? So there are a few main factors that the credit bureaus are going to look at to determine what that score is. The first and really the most important is your payment history. So this makes up the bulk of what they're going to look at, which is 35%. So really they're looking at, are you paying your debts on time? This is really important. If you need to pay all of those loans, all of those debts within 30 days, if you go past that 30-day mark, you're going to have what's called a late payment or a late pay. That is going to have a huge impact on your credit and really will lower what that credit score is. And just those recent delinquencies carry the most weight, and they can stay on the bureau and affect you for up to 2 years. So it's super, super important that you're making your payments on time every month. All right. The next part that, again, it carries a pretty heavy weight when looking at your credit score is your credit card balances. So this makes up 30% of your score. So what credit card balance means, it's the ratio became like what you owe on that credit card and what that maximum credit line is. So the goal of that would be to keep your credit card balances below 30% of the credit limit at all times. So for example, if you have a credit limit of $1,000, you want to keep that balance at $300 or less. And one of the things a lot of people are very surprised to learn, once you have a zero balance on that credit card, you do not want to close that account. This can have a negative impact on your score. So definitely once you have those zero balances, leave those cards open. You don't have to use them, but don't close those accounts. All right, next, and this is going to have a little bit lower of a weight, but is your credit history. So this is the length of time that you've had any type of debt or credit open. With that, it's about a 15% impact on your score. So what this is really looking at is that how has your payment history been? We are looking for patterns and just really your financial behavior. The longer that you have a credit history, the more chance you're going to have a higher score because we have more to look at as a lender. All right, the next thing we're going to talk about again are the types of credit, which we had mentioned before, the secured, the unsecured, the revolving. It's important that you have a good mix of all of those, having 3 to 5 open active accounts. And again, just having that mixture of secured loans, credit cards, just having that good mix. So again, as a lender, we can see those financial habits that you have. All right, and the last piece we're going to talk about are credit inquiries. This is having the lowest impact of all of the factors at 10%. So what this means is if you go and apply for a loan, when we pull your credit, this is considered a hard pull. And what we're going to do, we're really going to look at the number of inquiries you've had over the past year. And how much debt are you applying for? We really want to see that financial pattern. So we're going to look at things like, did you shop for an auto loan, then immediately apply for a credit card, then immediately do a mortgage loan? We want to see that, and it's definitely going to have an impact. All right, so those are really the main factors that I want to talk about, just the basis of what credit is, how it's established, the different types of loans, and really kind of how we look at determining what your score is.
Again, but so informative. So in the next few episodes, we're going to break down some of the other things that impact credit and how we can improve our credit and how that road is going to lead us to home ownership. So I hope our listeners, follow along for this journey and stay tuned for the next few episodes. Stacy, thank you so much for joining us on this episode of this Unbelievable Life. Stay tuned, keep listening.
Thank you so much.